Okay, this is Scott Cole from the Futures Trading Academy. One of the most important things that we teach our students is how to test the strategies that we might supply to them so that they can also build on, and how to test them over historical data so they can have more confidence in actually trading these strategies in real time with their real money. It makes no sense to us for a student to just simply take everything we say as gospel and start trading right away, which is the case with many of the trading courses out there. So what we do is we actually teach our students how to go ahead and test the strategies that we provide to them, and then we assist them in building upon those strategies and hopefully actually improving them. We definitely don't say that our strategies are just the absolute best in the world and they're going to make $1 million right away. We know that futures trading is far more difficult than that. So I'm in the Trader Studio software program developed by Murray Ruggiero, a contributing editor to Futures Magazine. And I believe he developed this software about 10 years ago, and he's consistently been improving upon it over time. And what we do first is we open up a trading session. I've got one set up here, and we're going to go ahead and edit it. And we're going to trade just a very simple 20-day channel breakout. We're going to apply a commission rate of $25 and slippage of $50 per contract. And here's our list of markets that we're going to go ahead and trade. And the beauty of this program is you can test a whole portfolio all at once, and you can even test multiple strategies on the portfolio all at once as well once you get into the trade plan, which comes up in a couple minutes. So here's our list of markets. We've got soybean oil, British pound, corn, Canadian dollar, crude oil, on down the line to the yen, coffee, etc. And we've got 21 of these markets, and we're going to go ahead and click next. And now we're going to save the session, and now we're going to run it. There's we could adjust that length if we wanted to. We're going to go ahead and just stick with 20. And we're just going to test this going back to about 15 years. And this will just test the basket of markets with one contract. And you can see that it's going through the test below. I'm going to go ahead and pause the video for a moment until we're just about done with the test. Okay, so we're just about done with the test, and we'll get our results here in a few moments. And you can see going back to that time frame, we made about $680,000 on 2,200 trades, 37% profitable. You could see the trade by trade results and analyze every trade. Here's our trade profit or loss, our running profit or loss. We can see the results on a monthly level, annually, and the test actually went back to only as far as 1999, and there's a reason for that. That one category where I determined the max bars back was 250, so I wanted to go back and start the test about a year before I start seeing the results. That's when it starts counting the bars, and it'll start counting the actual trades after we hit 250 trading days. So that's why the results don't appear until 1999. I actually tried to get it to the start of 2000, but didn't quite get to that level. So here's the annual results. You can see in 2008 how strong the performance was based on the fact that there were huge trends that year in both directions. So now what we want to do is apply our money management algorithm in a trade plan. So I've already got a trade plan in place here, and we're going to go ahead and edit it. And we're going to test the model with an account size of $1 million. We're going to use a percent risk plan to determine our risk. And we're going to use the Turtle Premium Data portfolio that we just tested. And now we get to this point and we can determine how much risk we want to take per trade. So I'm going to put in 1% to limit my risk to no more than 1% of my equity per trade. And the ceiling is simply the maximum number of contracts that you would trade in any given market, based on the size of your account and how much you want to risk. Once you get to about $100 million under management or in your portfolio, contracts such as the Eurodollar, you're going to be trading thousands of contracts because the price movement is so small on a daily basis. And we'll go back to we're trying to get to the beginning of 2000 really to see our results. And we'll go ahead and click OK, and you can see on the bottom that it's running the test. So I'm going to pause the video. At this point, we'll come back when it's about done. Okay, so we're just about done running through the numbers, and we should get our results again momentarily. And we'll see how we actually did when incorporating our money management algorithm. So as you can see, the actual profits dropped significantly, and it's mainly because in this regard we didn't make very much money on the short side. In fact, we lost a lot of money trying to trade the short side. So, but that's just the case with this particular system. Not very effective trading the short side, and we can run through our results. So in 2008, we actually only make about 30% when we incorporate our money management algorithm. And the reason for that would be the volatility in 2008 was substantial. So if our account hasn't really grown that much, we're only going to be trading a couple contracts at a time in many of these markets. And this is the trade by trade report. Every single trade. So you can see the volatility. So in heating oil, even though our account at this point is up to, we have a total profit of about $400,000 in our account, starting it with $1 million, so we're up to $1.4 million. We're only trading one contract in crude oil here at the end of 2007. Heating oil and unleaded gas were only one contract. Only trading two contracts in the Canadian dollar. This is because the volatility that year was substantial. So that's why the results are a little bit skewed compared to, and that figure of 200% profit going through the single contract test is really just based on a typical margin account size. It's not based on the actual size of your portfolio. So you kind of throw that figure out the window. So here's our yearly breakdown. Then we can look at our equity report. So we actually have a compound annual growth rate of just over 4%. Average margin to equity ratio about 19%. Our maximum drawdown 42%. And there's some really neat kind of data that we can get out of all this. So what we can then do is test another system, and I'm not going to do it now, but I'm just going to show you. We can edit the session wizard, and here are all the basic trading systems. Some of them came with the software program, and then some of them I developed. So if I wanted to trade, test a triple moving average strategy, I could certainly do that. Run through the same thing. And then we can go ahead and edit what we figured. So here we could test a 10, 20, and 50 day triple moving average strategy. This would, ATR Mult would determine our risk per trade in the trade plan then once we got done with this test. And there's all kinds of things that you can then do with this software program. You can test virtually any kind of idea that you can come up with, and you just have to learn some of the coding. So we'll go ahead and look at that real quick. So I'm opening the editor, And if I wanted to open one of the trading systems I've got set up, let's just look at that first one, Jam Break Risk. And there's the code. This system came with Trader Studio, so you can see all the green stuff there. If I want that little triple moving average strategy, I can open that up, and there's the triple moving average strategy based on some of the code that came with the program, and then I adjusted it to my liking. So that's basically one of the most important things that we teach at the Futures Trading Academy. So if you want to learn more about our one-on-one teaching programs, please visit us at thefuturestradingacademy.com, and we'll look forward to seeing you there.